So when an option is an early exercise candidate and there's an economic benefit to exercising that option, if the owner of that option forgets or chooses not to exercise, the benefit goes to the other side, which is the short side of the option.
You're listening to IBKR Podcasts. Find more conversations at ibkrpodcasts.com. Please remember, any trading discussions are for information purposes only and are not intended to portray recommendations. Please listen to further disclosures at the end of today's episode. Now, welcome to our show.
Hi, everyone. Welcome to IBKR Podcast. I'm your host, Jeff Praissman, and it's my pleasure to welcome back the co-founders of Market Chameleon, Will McBride and Dmitry Pargamanik. Hey, guys. How are you? It's great to have you back. My pleasure. We just wrapped up a great webinar on early option exercises, and we're going to take this opportunity in the podcast studio to discuss further the topic. Links to the webinar, if our listeners are interested, are going to be in the viewing notes. So, Will and Dmitry, just kind of a background, right? There's two types of options, American and European style. So, American can be exercised early, while European style cannot have early exercises and assignments. So, what we're discussing really is going to only apply to the American style options, which are really the majority of the options that trade on the major U.S. exchanges anyway. And let's kind of start with, before getting into specific reasons why calls or puts may be exercised, could either of you give our listeners a quick overview on, how options are used as, risk management tools?
If you trade options, any trader needs a effective risk management tool. Without it, it would be almost impossible to be successful in the long term. And when we talk about risk management tools, it's not only to help you avoid unnecessary losses, but also to trade efficiently so you could optimize your returns. And one of the key components to a risk management tool is to allow you to assess when is an option in early exercise. It's important to know if it's a candidate for an early exercise and help you make that decision. Should you exercise the call or should you exercise the put?
So let's start with calls, which give the owner the right to buy the stock if exercised. What are some of the common reasons that a call position would be exercised early?
And there could be many reasons potentially to exercise a call early. The most common is the dividend. You want to check if your call is an early exercise candidate right before the ex-dividend date. And the reason for that is that if you're a shareholder, a stockholder, you would be entitled to that dividend. The company issues dividends to the shareholders, but an option holder is not entitled to a regular dividend. And at that point, if you hold the option, you don't exercise it, you don't get the dividend. And right before the ex-dividend date, you have to make a decision. Should I exercise this call or not? And you really have to know if the option itself is a candidate for an early exercise, because not all options are. So you'd have to go through all the checks and make a decision. Should I exercise this call? And if it is a candidate for an early exercise, and let's say you don't exercise that call, well, you lose out on that dividend. Essentially, you would have a similar risk profile, but you lose out on the dividend, which is, again, if you're trying to trade
dividend,
efficiently,
right,
you want to optimize your
the stock
returns.
Would drop, so say it's a 50-cent dividend,
you
kind of by mathematical formula, the stock's going to drop 50% when it pays that dividend, right? So
the stock will adjust, right?
If the
stock will adjust.
Investor doesn't, if the investor holds on to that call,
will adjust accordingly.
It should be worth 50%, 50 cents less in that case,
the right
correct?
To buy the stock,
that's why another reason.
You no longer have the right to.
So, not only are they not going to get the dividend,
you
but
cannot get that
they'll
dividend
lose money.
that was paid out to the shareholders. So it'd be a missed opportunity.
Are there any?
Yeah,
And, besides
could
for,
be
a stock going ex
other
div, are
special
there any other,
reasons.
and again, I know there's several reasons,
that
but are there any
exist.
other sort of, kind of, you're
Maybe
going to, more
there's a
common
special
reason
deal
to
going
exercise a
on,
call
or
early,
that you'd want to
even if there
exercise
was no
early.
dividend or had nothing
Corporate
to do
action.
with it, going ex div.
Also, if a stock is hard to borrow, sometimes you may want to exercise that call and convert it to stock, because if you own the stock, you could lend it out and potentially earn that lending fee. So if the stock is hard to borrow and you want to stay long that stock, you don't mind staying long that stock, and you could potentially earn a yield on that stock if you lend it out, that might be another consideration. There are different reasons for exercising a put. The most common reason is for the interest rate.
So,
for the
is it the
interest that you
same
could
reasons for
earn on
puts, which
short
give the
stock.
owners the right to sell the stock, or is there,
When you
different
own
reasons
a
why
deep in a money
a holder
put,
would
let's say,
exercise a put early?
There's a difference, and it's basically a bet on selling, on the shorting the stock. It's a bet on the downside, right, that the stock will fall, similar to shorting the stock. But there's a difference between owning a put and being short stock. If you're short stock, you borrow the stock, right? You sell it, and when you sell it short, proceeds come into your account, right? You get the proceeds from selling it. It comes into your account, and that can earn interest in an interest-bearing account. Right? You have proceeds in there. Either you earn interest from the broker, or you buy, the treasury, but that can earn you interest. If you're long a put, it's a net debit. You're not earning interest on being long a put, and it's an opportunity caused by being long a put instead of short a stock. So if you have a deep in a money put that acts very similar to just being short stock, there's no time premium, let's say, nothing, very deep in the money, then you may want to do that analysis to see, am I better off exercising the put, converting it to short stock, bringing in those proceeds to earn interest. You still have the same position of being short. However, at that point, that account will start earning interest, and you'd have to go through that analysis to see if it makes sense. Yes.
Dmitry,
So
you've discussed the reasons why an investor would exercise a call or put early. But even if the data, points to it being the most efficient or quote unquote correct strategy,
right?
Are there reasons why an investor or trader wouldn't want to exercise early?
To exercise, you give that up, it converts to stock, the option goes away, and you're no longer protected at that strike. So it is a decision you'd have to make and go through the analysis, a cost-benefit analysis. Is it worth doing the exercise? Because once I convert that option to stock, that option goes away. Now, you either have a long or short position depending on the option that you exercise.
What could be done then? So, like we discussed in the prior questions, that you would be definitely losing some money on the table, leaving money on the table, or that call would drop in value, the dividend got paid, or so on with the interest rates of the puts.
If you
is there something that they could be
exercise,
they could do to sort of
a certain strike?
At least,
you lose,
not leave all the profit on the table if they ended up not kind of following the efficient strategy.
Ability to limit your risk to that strike, right? So if the stock drops, obviously you're not limited to that strike any longer. And if you wanted to actually limit yourself on that strike, you could turn around and buy a put on that strike. And that's where the cost benefit analysis comes in. where you say, well, is the dividend that I'm going to receive large enough for me to exercise the call, protect myself on the strike by buying the put, and still be left over, have enough left over to make economic sense. So you could go through that exercise, and you don't have to necessarily just exercise the call and be long stock. Because you're receiving that dividend, you could use some of the proceeds to go and purchase a put to protect you on that strike, right? And that could also make sense where you don't cash out on the total amount of the put, but only a portion of it. And same thing to exercising the put. When you exercise a put, well, your short position is no longer limited to that strike. And if you do the analysis and the scenario, and you're like, if I'm going to maintain a short position from now to that expiration, how much do I stand to make in the interest that I'm going to earn, and what would it cost me to buy a call to protect my upside in case the stock goes back up through that strike? So there is an analysis you could do and other actions that you could take to at least benefit from some of the dividend or some of the interest, and still create a synthetic to protect your risk.
We've discussed some of the reasons why options are exercised early. Obviously, if an investor or trader is short, they run the risk of being assigned early. I'm assuming that they need to look out for this, exact same circumstances that the long holders are looking for, just to decide whether, they're at risk or not, to make a judgment on how to handle it. But as we just discussed, it's not always black and white. An option may not be exercised early. So what are ways the other side of that? You just discussed the holder.
Yeah, that's
how
exactly
they kind
right.
of risk manage around it. What are ways the investor or trader that are short the option can risk manage around the uncertainty of being assigned, because they have no control over whether or not they get assigned or not, whereas the holder has control over whether they want to exercise.
They have the right, you'll have the obligation. So you can't stop from somebody else exercising that option, and if you're on the other side of it, you're going to get assigned. And if you're looking, if your risk management tools go into your portfolio and say, look, that you short these options and they're a candidate, or you're at risk of getting assigned on these options, and if you don't want to carry the risk of potential assignment, at that point, really, you may want to just close out or trade around it in a way that you're not going to carry that risk. So you really want to look at it from both sides. Like you mentioned, should I exercise? If this is an early exercise, should I exercise it? And if I'm short it, I have the potential to get assigned on it, should I close out of it, trade out of it, so to avoid that risk? Yep. Yes.
But it sounds like the person who is short the option would generally benefit if it's not exercised early, when it was supposed to, like by the, kind of standard risk management tools. It's sort of, again, they could outmaneuver themselves and buy, hedge themselves off, and then it doesn't get, they don't get assigned.
So
and
when
all of a
an
sudden they've kind of spent some extra, premium
early
kind of hedging around,
candidate,
thinking they're going to be assigned.
But
that's the accurate statement, that the person who's short the position,
if the
benefits if it doesn't get exercised,
forgets or chooses not to exercise, the benefit goes to the other side, which is the short side of the option. So imagine if you're if you have a deep in the money call and you're short that deep in the money call and you're long stock against it, or you're carrying this buy rate, well, if you're not assigned on your call, then your long stock will receive a dividend, right? So you actually receive the dividend. If you're not assigned on it, in your long stock, your stock doesn't get called away, that stock will receive that dividend. So yes, the benefit will go to the shorts, the person on the short side of that option. If somebody forgets or chooses not to exercise an option, that is a good candidate for an early exercise. Yeah, I think
this was a great discussion. I really, first of all, really enjoyed the webinar we just did prior to
trade options. You
this
should know
podcast.
that.
And
when is a
now
call
this podcast. So
candidate for an early
any
exercise?
last thoughts you'd like to leave our listeners with
how to do the
on the
cost
early exercise and assignment of options
analysis, and make it part of your risk management tools. So you don't want to avoid having a situation where you forget accidentally, or you're not paying attention, you get assigned when you don't want to. You need to always have that as part of your risk management tools. If a put or call is a candidate for an early exercise. So I'm just going to leave it at that.
No, that's perfect. And again, for our listeners, for more detailed information, there's a link to the webinar we just finished up on this exact subject that I would highly encourage everyone to go.
Thanks,
it's going to be in the
Jeff.
study notes. And you see more educational material from Market Chameleon. Go to IBKR.com, click on education in the top right and IBKR campus, then click on our contributors and look for Market Chameleon. Thank you for listening. Until next time, I'm Jeff Praissman with Interactive Brokers.
Thanks for listening to IBKR Podcasts. As always, we have more episodes at IBKRpodcasts.com. And if you're interested in learning more about Interactive Brokers, visit IBKR.com. We offer more trading education material, such as webinars at IBKRwebinars.com, financial and economic commentary at tradersinsight.news, market-related courses at tradersacademy.online, and quant-related articles at IBKRquant.com. The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. The material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances, and if necessary, seek professional advice. Options involve risk and are not suitable for all investors. For more information, read the characteristics and risks of standardized options, or ODD, which may be accessed through the link found in the show's notes or podcast description page.